435%. That's the average annual return the stock market has produced since 1926. It sounds great, but it's not what you think. Stay tuned, and I'll reveal why. Stocks vs. real estate, which is really better, and get ready to be surprised. Hey there, I'm a professional with a financial firm, and today we're answering a question that's been debated for ages. Which will make you more money, investing in the stock market or in real estate? Let's dive right in. So, why are we even having this discussion? Well, according to a recent study by TD Ameritrade, nearly 3/4 of all Americans have at least some of their savings tied up in real estate, but many are still turning to the stock market too, with 58% of people without a house owning individual stocks and 52% investing in mutual funds or ETFs. So what gives? How come so many people want to invest in both? The answer is simple. Both the stock market and real estate offer unique advantages. Real estate can provide a stable long-term investment with cash flow and tax advantages, while the stock market offers diversification, growth potential, and the ability to build wealth over time. However, only one of them can truly come out on top. So which one is it? Let's start with the good old stock market. As an investment, stocks have historically provided higher returns than real estate, according to the data from the Federal Reserve. Since 1926, the S&P 500 has returned around 10.5% annually on average, adjusting for inflation. In comparison, the annualized rate of return for real estate is just 3.25%. But wait, you may say, you've got to factor in the fact that unlike the stock market, real estate requires constant work. Sure, there are property managers, but you're often still left with some headaches and expenses like repairs, vacancies, and all that. With stocks, everything's automated. You buy shares and that's it. Your income is automatic and you don't need to worry about any of the upkeep. And it doesn't stop there. While stocks may have outperformed real estate on average, they're also a lot more liquid. What does that mean? Well, in short, you can sell your shares quickly and easily, unlike real estate. Selling your house could take months and you're always at the mercy of the market. However, there is one important thing to keep in mind here. The stock market is volatile. Yes, it has outperformed real estate, but that's not necessarily going to be the case year after year. There are ups and downs, and sometimes real estate does better. We saw that firsthand during the pandemic when the stock market was hit hard and real estate actually came out on top. The S&P 500 lost about 33% of its value from February to March 2020, while home prices continued to rise. So let's shift our focus to real estate. As we mentioned, one of its biggest draws is the potential for cash flow. Unlike stocks, where you typically rely on dividends, real estate provides rental income from day one. If you own a property, you can rent it out to a tenant and receive a steady stream of cash flow every month. And if you buy a property below market value, you can immediately start making money. Additionally, real estate values have historically increased over time, making it a great long-term investment. This appreciation can lead to significant wealth building over the years, especially if you buy in a prime location and hold on to the property for a long time. And let's not forget about those sweet tax advantages. As a real estate investor, you can write off a wide range of expenses, including mortgage interest, property taxes, and depreciation. These tax savings can add up quickly, especially if you own multiple properties. Now, stocks also have their tax advantages, but they're nowhere near as lucrative as those offered by real estate. Now, as we've already mentioned, real estate is a more hands-on investment. It requires active management. Whether you hire a property manager or do it yourself, you're responsible for everything from finding tenants to handling repairs and making sure the property is always rented. Plus, you're always on call for emergencies. This hands-on approach means that real estate can be more time-consuming than investing in the stock market. So now we've explored the advantages of both. It's time to reveal which one truly comes out on top. And the answer might surprise you. A recent survey conducted by Charles Schwab sheds light on this. They asked over 2,000 people who had invested in both stocks and real estate which one they thought was better. And guess what? 71% of respondents said that stocks were better. So how did this come to be? We dove deep into the responses and found that the reasons people preferred stocks came down to three things. First, there was greater potential for larger returns. Second, stocks were seen as less work. And third, they provided more opportunities to diversify. Now, while these are all solid points, something interesting came out of the study too. Nearly half of the respondents said that they would choose stocks over real estate again. But here's the twist. Despite favoring stocks, a significant portion of participants reported earning more from their real estate investments compared to their stock portfolios. It's intriguing because it suggests that although stocks may be perceived as more favorable, real estate continues to be a strong performer. So which should you choose? To be honest, there is no one-size-fits-all answer. The best choice for you will depend on your unique circumstances, goals, and risk tolerance. If you're looking for more passive income, then the stock market may be the way to go. Thanks to the power of compounding, it allows you to buy once and sell later, potentially sitting back and letting your money grow over time. But remember, the stock market is unpredictable, and your initial investment won't increase until you sell your shares. On the other hand, if you prefer a more hands-on approach and want the added benefit of rental income, real estate might be the better option. However, it's important to note that real estate also comes with a lot more responsibility, from managing tenants to dealing with repairs and vacancies. Let's not forget about another crucial factor: financing. Getting a mortgage for a property can be a strategic move, as it allows you to leverage other people's money and potentially earn a higher return on your investment. But it's not all sunshine and rainbows. Interest rates play a big role in determining how much you'll pay over the life of the loan. To illustrate, let's compare two scenarios. Imagine you want to buy a $200,000 property and put $20,000 down. In the first scenario, if you secure a 5% interest rate over 30 years, you'll end up paying about $93,000 in interest over the life of the loan. But if interest rates rise to 7%, your total interest paid jumps to $150,000. That's an extra $57,000 you'll spend on interest alone. Now imagine you decide to invest in the stock market instead, by putting that same $20,000 down payment into an S&P 500 ETF that historically averages an annual return of 10.5. You could potentially have around $1.4 million after 40 years. Now, of course, this is a hypothetical example, and past performance is not indicative of future results, but it shows how the cost of financing can significantly impact your investment returns over time. Ultimately, the decision of whether to invest in the stock market or real estate, or even both, is a personal one. Both options have their own set of advantages and challenges. So before you decide, consider your financial situation, long-term goals, and risk tolerance. And hey, there's no harm in seeking professional advice to help you navigate this exciting journey towards building your wealth. And that's a wrap for today. But before you go, we'd love to hear from you. Have you had more success in the stock market or with real estate? Share your experiences in the comments below. Also, if you found this video helpful, don't forget to like and subscribe for more insightful content like this. Thanks for joining us today, and we'll catch you in the next one.